If you're an American and you're going to be settling in Canada and becoming a tax resident of Canada, there's a few things that you should know about the differences between our two tax systems. They're very similar, but they do have some little variations that you need to know about. So the biggest difference between the Canadian system and the American system, and in fact between almost every system in the world and the American system, is that the Canadian tax residency does not depend on your immigration status at all. A Canadian citizen who leaves Canada and settles somewhere else is no longer a tax resident of Canada and doesn't have to file taxes here in Canada unless they want to, for most people. But the American system if you're an American citizen, you still have an American tax filing obligation. Canada, it's not like that. If you settle here in Canada, regardless of your citizenship, you become a tax resident of Canada, and when you leave, you cease to be a tax resident of Canada. There are some exceptions to this. You can be physically located in Canada and be a non-resident, but those are usually in one of three situations. One situation is if you are in Canada, but you are a member of the armed services from another country and you're stationed here. Another reason is if you are a diplomat in Canada representing your country. And the other one is if you are a student living in Canada to go to school, but your home base is still in your parents' home country, then you can be considered a non-resident of Canada, even though you are physically located here. But for everybody else, if you are domiciled here, if you live here, if this is where you normally spend your time, you're a tax resident of Canada. Another difference is that for most Canadians, they only file one income tax return. In the United States, there are a lot of states that have their own state return. So you'll file a federal return and a state return. In Canada, we have provinces, of course, and every province except one is harmonized with the federal system, which in this case means that you file a single return and it calculates both your federal and provincial taxes. The exception to this rule, as is so often the case, the only exception is Quebec. Quebec is the only province where you need to file two returns, a federal one and a provincial one. Another difference between the American and the Canadian system is the way that we treat your investment income. In the United States, there are a lot of questions on the American tax return about whether your investments are short-term or long-term, and they're taxed slightly differently on that basis. In Canada, we don't tend to ask that question, and all investment income is pretty much taxed the same, regardless of how long you held it. A slight variation on this rule: if you are a day trader, so you're regularly doing a lot of trades every day, that income can be taxed a little bit differently from somebody who just invests and holds on to some shares for a while and then sells them at a profit. But the difference between the investments that are held for the purpose of investment and the investments that are held for the purpose of day trading, while they are treated different in the tax system, they're actually not that clearly defined under the law, at least not yet. In the United States, you may have had an IRA account. In Canada, we have a very similar tool called the Registered Retirement Savings Plan. We often refer to it as an RRSP. And this is similar to the IRA in that investments that are placed into the RRSP, you get to benefit from a tax deferral, an income tax deferral in the year that you put the funds into the RRSP, and you will pay income tax only if and when you remove the funds from the RRSP. And also, like the IRA, while the funds are sitting in an RRSP, if they earn any investment income, that income is tax-free. Along those same lines, the Roth IRA in the United States also has an analogous account here in Canada called the tax-free savings account, or TFSA. It has very similar rules, but I will give you a warning. If you are still an American citizen, you are still obliged to file American tax returns. And if you file an American tax return and you have funds in a tax-free savings account in Canada, that is treated in the American system as an offshore trust, and it can complicate your American tax return. So it's usually advised, if you are still an American citizen and you are still filing American returns, which is your legal obligation in the United States, it's probably best to just stay away from the TFSA. Just don't have one, because it's probably going to be causing you more problems than it's worth. In the Canadian system, Not everybody has to file a tax return. You only have to file if you owe tax. If you are earning very little money and it's not enough to bring you into the taxable level, you can choose not to file a tax return, and that's perfectly okay with the Canadian system. However, it's probably not a great idea for you, because most people who are making little enough money that they are not triggering income tax actually have some tax credits coming to them, basically government money that is due to you, but you only get it if you file the tax return. So that's sort of the irony here. You don't have to file, but you should if you're not earning enough money to be taxable. Another difference is that we don't have the tax status that is called married filing joint in the United States, where one person basically files a return on behalf of the entire family as sort of head of household. We don't have that system in Canada. We don't have that term. Everyone is supposed to file their own income tax return. Now, that's not to say that your income taxes aren't intertwined with those of your spouse and or your dependent minor children. They are. There are things about your spouse and dependent minor children that you are going to record on your own tax return, and it's going to have an effect on your ultimate tax liability and any credits you might be entitled to. However, it's still considered your return and only your return, and your partner still has to file their own return if they earned enough to be taxable, because like I said before, if you don't earn enough money to be taxable in Canada, technically, you don't have to file a return. And since the person who is taxable has already recorded a bunch of information about the non-taxable partner's income, it's really not necessary for the non-taxable partner to file. And so you're in a situation where, once again, one person is filing, kind of on behalf of the family, and the other person is not. We just don't call it married filing joint. We would just call that one person is filing and the other person isn't bothering because they're not owed any money and they don't owe any money. Married couples and common law couples are treated pretty much the same. Under the Canadian tax system, there's really no difference. They file the same way and they're subject to the same rules. You become common law when you live in a conjugal relationship under the same roof with someone for 12 consecutive months. Now, if there's a breakup and a reunion and the split takes less than 3 months to resolve itself, that 12-month period is considered to be unbroken. If the breakup is longer than that, you'll sort of restart. But if you've been in a relationship and you're living together and you've been living together for 12 months, by the end of that year, you are considered to be a common law couple, and you'll be subject to the same tax laws and have the same tax opportunities as a married couple. If this video helped you, please give it a like so that it can help other people too. And subscribe if you want to see more tax tips for Canadians. I'm Sunny Weiderman from Personal Tax Advisors, and I'll see you in the next one.